What is an income statement? How can you read an income statement? What is it for? What's the point of it? In this video, we're going to go through income statement, how to read it, how to understand it, and how can you use it to understand about your business or property's financial information. You remember Robert Kiyosaki? In a way, he was the father of financial preaching and the author of Rich Dad Poor Dad. This is probably the book that is on top of your favorite TikTok investors reading list, and they live by it, since he said that most young people don't know how to read an income statement as if it's some sort of a rocket science. So in this video, I'm going to explain to you income statement, how to read it, what are some of the elements of it, and how can you use it to analyze your business's financial information. Let's go. Every business needs a report card. What do I mean? Well, how do you know if your business is doing well? You just want to look at your bank account? There has to be some way of unified reporting for you to go and look at it to say, hey, my business is doing well, my business is not doing well. For every business, there are 4 different financial statements that can help you understand your business's financial performance. I think 2 of those deserve their own video: income statement and balance sheet. But let's just go through all 4 of them together very fast. You have income statement, or they call it profit and loss statement, which outlines your revenues and expenses and gives you a net income. You have the balance sheet, which outlines your assets and liabilities and then determines based on those what is the owner's equity. You have a retained earnings statements, which says how much of the net income from the previous year you retained this year. And you have a cash flow statement, basically says what is the inflow and outflow of cash into your business. Yes, you might make a lot of money, but what happens with your cash flow and liquidity? Today, we're going to discuss income statement. Again, a huge disclaimer: this is not meant to make you an accountant. We're just gonna have a surface level look at this. Maybe we're gonna dabble into accounting a little bit, give you some of the elements, but this is just for you as a business owner to understand how to read it and what does it mean, and not necessarily making you an accountant who does journal entries, understand the building blocks of each, categorize each one, and or how to put it in your tax return. So always consult a CPA, they know best, and they also have understanding of the laws and regulation to help you take full advantage of the tax code. Without further ado, let's go. Income statement. Let's make an example. I made my company. I made my dream company. I always wanted to make a company and run it. And as you can see, I found a very appropriate name for it. And I want to take a look at my profit and loss statement or the income statement. So first part of that is your revenue. Obviously, that's what every new business is worried about. How do I make money? How do I increase my revenue? Well, here is an income statement or profit and loss. You're going to see that some of the elements of your revenue, basically something that you're looking for. In this example, we're thinking it's a product company that provides a product, sells a product. So gross sales is a very good indicator of how much you're selling. There are more elements into this, but for the sake of this video, we're just going to go very basic. So, it's your gross sales. You have to deduct whatever returns, discounts, or allowance that you have. But then if you do that, the net of it is going to be your net sales. And obviously, in this case, we have data from last year and this year. We're pretending we're in the Q1 of 2022. So for 2021, we have the full year information. For every element of an income statement, you can actually look at it individually. You can compare it to the year before, or you can trend it. You can do it monthly, quarterly, annually. You have it all. If you remember the efficiency ratio video, if not, links up, we discussed 2 things: benchmarking and trend analysis. The same principle applies to these as well. You can benchmark them relative to your competitors. Also do a trend analysis based on your historic performance. Again, net sales, net revenue, total revenue is a really important metric because it measures the performance of your company. Again, your company is there to make money. If you fail at making money, then what's the point? You need to change something. So looking at the total revenue is very important. Also, when it comes to a lot of sectors, total revenue is very important. Why? Because it discusses their growth trajectory, what percentage of the market share they hold, what is their new strategies going to be. But as we know it, revenue can be very misleading. You can make a lot of revenue, but then end up losing money. So now, for the first time ever in our income statement, we're dealing with a cost. Wait a minute, Poria. You said that first we're going to discuss revenue, then expenses. Why you have a cost up here? Well, this is a cost of goods sold. So right after you have your total revenue, you need to understand that what did it cost for you to sell this product? Cost of goods sold is essentially all the core costs that are associated with you selling your product or services. For services, you might see something like cost of services sold. It's the same principle, but cost of goods sold is very common for product sales, manufacturing, suppliers. Why is cost of goods sold here? The reason for that is you want to have a pulse check on saying if your revenue is justified. Meaning, here's a principle: if you are losing money per unit, you are losing money, period. Doesn't matter how much you sell. So you can have a ton of revenue, but then if you're losing money per unit sold, you're losing money. So you want to know it right off the bat for your core product sale. How much revenue you make, what was the cost to sell it? So this way you have something called gross profit. we'll get to that later. These are some of the examples of what a cost of goods sold is. What are the categories of cost of goods sold? What can you put in cost of goods sold? Because sometimes it's tough to differentiate between operating expenses, additional expenses, and cost of goods sold. Cost of goods sold, think of it as what you need to spend on to sell this product. Very core. For example, something like raw material or freight cost is a cost of goods sold because it deals with you making and then shipping the product to the customer, or it's core to selling your product. But at the same time, something like rent for your office or your administrative cost is not cost of goods sold. That's the cost to operate the business, not necessarily involved in strictly selling the product. Again, those examples are really good. Always you can refer back to them. There could be more examples. For cost of services sold, because there are services, for example, professional services, you can think of core salary of the folks offering that value, and also whatever cost that goes into providing that value to the customer. Cost of goods sold is good. That's what my accounting students get very excited. That's where your calculation comes into play. Essentially, to calculate cost of goods sold, you look at beginning inventory plus purchases and then deduct the ending inventory, and that's your cost of goods sold. And there are 3 ways to calculate the cost of goods sold: FIFO, LIFO, and average cost method. Again, this is where all the freshman accounting students get confused. This is the first in, first out, meaning you basically calculate it based on inventory that comes in first. LIFO is the other way around, last in, first out, and cost average method is just basically using the average cost for that period. For example, I work with a lot of restaurants and hospitality. Code 5200 and 5330, which are food cost and liquor cost, are the most common cost of goods sold because they are in the business of selling food and liquor. So the cost to procure those and to prepare those are the cost of goods sold. So that's just a good example for one vertical. So now you have your revenue, you have your cost of goods sold, you deduct the one from the other, and what you get is gross profits. We love profits. Profits are always cool because it basically shows you how efficient is your core operation. Yes, you made a ton of revenue, but what was the cost of your goods sold? If you have a very healthy gross profit, well, congratulations. The first step is done. You're making money by selling your product. You're not losing it. Bad news is when you have a gross loss, meaning before you even pay for any of your operating expense, you lost money just for selling your product. So you have to make a lot of revisions. You have to think long and hard about what is going on. Maybe your pricing is off. Pricing is very important because if you don't price your product well, you're going to lose money, or that your cost of goods sold is too high. Maybe you need to change your vendor for the raw material. Maybe you need to change your shipping route. Maybe you need to decrease the overhead cost, or also maybe you need to implement some efficiencies to make the whole process a little bit more efficient, a little bit more cheaper, so you can end up making some money. Because if you have a gross loss at this point, you haven't even paid for your operating expense, so you don't want to be in a position that you just have a lower and lower margin as you go on. So it's a really good measure. It can measure your effectiveness and efficiency of producing and selling your product, and also helps you with pricing. Well, the good news is my company, as you can see, the sample company, is making gross profit, so we're doing well. It seems like we're doing well. Then we can also perform trend analysis or benchmark it. But next step is expenses. While revenue is mostly focusing on growth, building, selling, going out there to the world, introducing your product, and it's about how much money you make, expense is about your cost. There are different types of expenses. These are the types of expenses we commonly use. There are more categories if you want to go deeper into the accounting principles, but these are the most commonly known that you should probably know as well. We know cost of goods sold. We're going to talk about operating expense, and then down the line we'll talk about financial and non-operating expenses as well. For my sample company, these are the examples of my operating expenses. Again, there are more categories on that. These are the things that your favorite investors on social media talk about write-offs. Again, Schedule C has its own different laws and regulations, which we'll discuss as well. I'll put a link down below on IRS's instruction on Schedule C. Obviously, always consult a CPA. But since my company is an S Corp, I have these expenses. Again, as you can see, these are things like marketing, advertising, sales, rent, utility, wages and salaries expense, things that I need to run my business. Again, having an office, having an administrative assistant, paying the rent for the office, they're not core functions of creating the product. They are functions of a business that I made surrounding the product. So that's why I call them operating expense. Expense to operate the business. Again, if you have an accountant or bookkeeper that does it for you, great. If you're doing it yourself, make sure that you give an accurate categorization of where these expenses are. For example, if it's travel expense or if it's utility expense. So now I'm going to talk about real estate for a second. And when it comes to expenses, usually businesses are very organized or should be organized. Unfortunately, in real estate, they're not that organized. So if you're a real estate investor and you have dreams of opening your own holding company, always make sure you have a really good, accurate record keeping and also good accounting, because you are a business. Act like a business and make the record keeping very clear. But what is financial expenses? Well, financial expenses are not really operating, nor their cost of goods sold. They are expenses that deal with borrowing money, some things like cost of capital. For example, if you go and get a working capital loan and the interest you pay on that is a financial expense. So it's not operating, not a cost of goods sold, but it is an expense. But when you want to categorize it, it is cost of financing. We did it. We're through all of it. We talked about revenue, we did cost of goods sold, we went through our expenses. So now we have our magic number. Obviously, before you get to net income, from an accounting perspective, there'll be more steps because you might have other incomes that should be categorized here. If you have other expenses, as we discussed, some of the things like interest expense, some of the specific depreciation or amortization, which we'll discuss later. So on a case-by-case basis is different, but generally as a skeleton of an income statement, you have your gross profit, which is revenue minus cost of goods sold, and then that is minus the expenses that you have. Could be operating expense, financing expense, non-operating expense, and then you have your net income, which is great now that you know exactly how much money your company made. Again, net income is very definitive. Basically means it's after all said and done. If you deducted all your expenses, if you did everything that is tangible and intangible, and that's just the net income that you made. Again, income statement, just like other statements, is very accounting focused. It goes by general acceptable accounting principles. So there are rules and regulations that need to be followed. There are some elements in the tax code that can help you, like amortization and depreciation. So net income is a very accounting measure, but when it comes to evaluating your business, whether it's performance or evaluation, net income is very important. Income statement is a report card for your business and its revenues and expenses. You have total revenue minus cost of goods sold, minus operating expenses, minus other expenses, plus additional income. And at the end, you'll have net income. And that's a good measure to perform your business's performance. Hopefully for your business, it's always positive. But as always, thank you so much. Thank you for watching. Tell me if you have any other statements or any other fundamentals that you want me to discuss. It doesn't have to be real estate. It can be business as well. I work with a lot of small businesses. Lately, my career has been very focused on small business. So if you want to buy a small business, start your own small business, let me know what topic works for you. But in the same time, if you want to know more about efficiency ratio, a really cool ratio that measures if you're making enough sales, are you using your assets, watch the video up here. For my real estate folks, I made a video on the market, scary real estate market shift, market crash, all these terms are coming in. I made a very long video dissecting our market. Watch it here. Other than that, thank you so much for watching and keep learning. See you next time.